our viewers, this GTV chart on the Bloomberg just showing the recent China economic numbers. And of course, we saw retail sales growing for the first time since the pandemic. What are some of the market calls that you like around this narrative of Chinese consumption recovering?
Thanks a lot for having me today. My co-PM Stephen and I, one of the stories we really like is about travel-related stocks as a major beneficiary from post-COVID recovery in the next 6 to 12 months. What we've witnessed in China is that there's a huge pandemic demand on travel, especially leisure travel. So on domestic travel, we've seen domestic flight passenger volume recover to more than 90% of pre-COVID levels. And we're seeing very high hotel occupancy rates in popular tourist destinations such as Sanya. On outbound travel, Chinese government will fully resume IVS visa to Macau at the end of September, and essentially creating a travel bubble between mainland and Macau. This is making Macau the only outbound travel destination for mainland Chinese without 14 days of quarantine requirements on both ends. So we're really excited about this travel-related stocks, and above being said, we remain selective and only buying stocks with attractive valuation, quality business models, and strong competitive positioning in their respective segments.
What about the broader Chinese market? Because we continue to see this rally not only in China, but across the world. And now everybody's worried about valuation levels. So do you see some froth and excess in the Chinese markets, or are we at fair value?
We believe overall market valuation is fair at the moment. MSCI China is trading at about 14 times consensus 21 PE, which is about 20% higher than its past 5-year average, which we think is a fair reflection of higher mix of new economy companies in the index, as well as strong liquidity across the globe. And in addition, if you look at MSCI China relative valuation to both MSCI EM and S&P, they are both, all the relative valuation are both at the historical average level, which is a reflecting of strong liquidity across the globe. And with this backdrop,
Sorry, Ivan, I'll let you finish.
Yeah, we remain very constructive on the Chinese market on economy recovery post-COVID-19, and we also see potential earning upsides in 2021 to 2022.
How do you feel about the tech sector there in China, particularly if these tensions with the US continues? There's many people saying that we're setting up essentially for a bifurcated set of tech worlds, Western and China.
Yeah, in general, actually, even go beyond tech. We think the risk between US-China relationship is a risk for the market, and it will remain there for the foreseeable future. In general, the strategy we apply on dealing this kind of risk is we always think about risk-reward in terms of what are the likely outcomes of an event and what have been priced in by the market. This allows us to stay alerted when the market is overcomplacent overcomplacent, and on the other hand, allow us to take calculated risks when the market is too pessimistic. So in terms of you mentioned the tech war and also Huawei ban, I think the market has been digesting the news since May 15 on the Huawei ban, and a lot of the short-term impact has been pricing. However, it will take a while for us to see how much of the impact is temporary and how much is permanent. So it takes time.
In terms of consumer names, we've been looking at just the popularity when it comes to, for example, multi. Are valuations too richly priced in this sector for you to find it attractive?
We are actually current holder of Multi. Multi is an exceptional brand that we think even at this valuation, it is still risk-rewarded attractive. However, we do find more difficult to find risk-reward attractive names within the consumer staple sector, and therefore actually in our portfolio, we're underweight this sector.
What about the banking sector? Because, of course, we know that China's banks are famous for really not only a lot of leverage, but also the fact that they've had to carry the economy towards a recovery. They've had a very heavy burden.
Yeah, we actually, in our portfolio, we're underweight banks, and we've always been constantly review our decisions in this. And what we found is from the bottom-up stock selection point of view, We see lack of catalyst to drive re-rating in the near term for the banks. Therefore, we believe the reward is not attractive enough to offset the potential risks on earning and asset quality for the banks, especially when we compare to our opportunistic set of universe in other sectors.
And of course, Ivan, all of this coming at a time when we're seeing continued strength in the Chinese yuan. This GTV chart on the Bloomberg showing how it's been lifted to the highest this year, breaking through that key 200-week moving average. How are you assessing the direction of the Chinese yuan, and at what levels when you're making these calls on the equity markets?
First of all, we are very much bottom-up stock fundamental-driven fund. So CNY US dollar exchange rate is an input, as many of other inputs in our models. I think about risk reward, but it's not a single top-down call we're doing on the exchange rate. But what we've been seeing in the Chinese yuan and US dollar exchange chart is basically, this Chinese yuan appreciation is very much driven by the weak US dollar, as well as the strong economic recovery in China, since China in the COVID situation being first in and first out. And also this strength in Chinese yuan is also a result of very strong current account surplus, as the export sector has been holding up really well during the COVID.
What would you be betting on in terms of the infrastructure and the stimulus-driven recovery in China?
What we are doing here in terms of infrastructure, for example, we're looking at more longer term and thinking about more structural secular tailwind. So one thing we're investing in is 5G, because 5G rollout is one of the high priority for Chinese new infrastructure initiatives. And I think we are likely to see acceleration in 5G adoption in the next 12 months as more 5G smartphone models become available. So that's one area.